Hey everybody. So today I wanted to talk about something. A lot of people ask, "Hey, I heard that the mortgage rates are 5%, let's just say." And they think everybody gets 5%. Or maybe there might be some slight variances in regards to some might get slightly better than 5%, others might get slightly more. Generally, the rate that you hear quoted is the lowest rate for the highest credit borrower for a primary residence. And if you can believe this, it's actually for putting somewhere between 30 and 40% down. Anything outside of that, if you put less down, 20%, 15%, all the way to 0 or 3%. And if your credit score is below a 740, then that affects it as well. And the other thing that affects it is if it's not just a single family residence. So a lot of times there is townhomes or condos, and then beyond that you have second homes. So it's not a home that you spend the majority of your time in, or possibly an investment property as well. So it's one maybe that used to be your home, or you're buying it just strictly as an investment property, and now you don't live there at all, you have a full-time renter. So what I wanted to talk about is when you hear the going interest rate quoted, let's just say 5% is the rate you hear quoted, that is not necessarily the rate that you're going to get or almost anybody's going to get. What we're looking at here is something from Fannie Mae that is what we refer to in the mortgage business as adjustments to price. So it's not adjustments to rate. A lot of times, so let's say you hear the 5% rate quoted. A lot of times that has a half a point or maybe a 1 point fee. And then that's how you get an APR that is significantly higher than the interest rate, meaning that you're having to pay points, whether it's an origination or a discount or something of that sort. So that's adjustments to price. When you pay some type of fee to get that rate, that is the cost to get the rate. Our terminology in the industry is adjustments to price. So in reality, everybody has access to the 5% interest rate. It just depends how much is it going to cost you to get there. And what impacts that a lot, I want to share that with you. This probably looks like a very complex chart. What it shows here is across the top here is your loan to value on the property. So this column here is 60% and less. So if you owe less than 60%, then these apply to you all the way down to 20%, 40%, whatever. These are the different categories, 60.01 to 70%, and so on, all the way up to 97%. So this is the balance of the loan you're taking out against the value of the property that you're buying. And you'll see that some of these have NA, not available. Now, a lot of these have always been not available, but some of them have just recently become not available. These loan to values, like you'll see right here, you go, hey, why is there an NA right in the middle of all these? Okay, so a 3 to 4 unit adjustable rate mortgage as an investment property, you can no longer borrow 80.01% or above. It's capped at 80%. Let's go down here. This is credit score. So as you can see, it's broken down into these categories, 740 and above, 720 to 739, all the way down to less than 620. So these are adjustments to price, or in other words, you getting 5% as your rate. Now, as a lot of you may know if you've been in the business before or are currently, or you've borrowed multiple times and been offered different scenarios, sometimes you can take a little bit higher rate, let's say 5.5, and then lender says, hey, we can pay all your closing costs. But at 5, you've got to bring in $15,000 to closing. Well, they're looking at the adjustments to price and what this loan costs to bring to the table and whether they can help you out with the closing costs or if you're just going to have to bring them all in. And why credit score is very important, let's just look at something here. We'll go right here to the 70 to 75% column. And so you can see that the adjustments to price is the person who has a 740 or greater still has to pay a 1/4 point fee to get that loan. So let's just say it's a $400,000 mortgage. A quarter point is $1,000. It's a quarter of 1%. So anything in front of the dot is a whole percent. Everything past is a partial. So a 1.00 hit, like the person with the 700 to 719 score has, that is going to cost $4,000 on a $400,000 loan. You can see how credit score really impacts you, because you get up here to the 639 and less. These people have to pay 3 points in order to get the same rate as someone as a 740 or above. And that's why you might sometimes hear, oh, we'll do your credit, your rate's 5.75 or your rate's 6%, not 5. Oh, why? You don't like me. I'm going to go check with someone else. No, it has to do with just basically a few factors. One is the loan to value. 2 is your credit score. And 3 is the type of property. So, because you can even see, look over here, look at how the hits get even more dramatic over here for the credit scores. You can see it goes all the way up to a cost of 3.75%. Here's another classic one. So we'll move. So that's the credit score area you can look at. We're not going to talk about all these. There's some different loans: cash out, refi, high balance. I just want to help you understand 80-90% of the people fall right here. It has to do with the credit score and the type of property. So the other one I want to talk about is the type of property. As you see, single family residence is not on here because there's no hits if you're buying a standalone home that's not connected to anything else. Beyond that, there are hits if it's an investment property, if it's a second home, if it's 2 units, that's a duplex, or if it's 3 to 4 units. If it's a condo, what? I have to pay a higher rate if it's a condo? You do sometimes. If it's a manufactured home, what? I have to pay a higher interest rate just because I'm buying a manufactured home? Fannie Mae they have looked at the risks of these different types of loans, and they charge banks a higher rate or cost to deliver this loan into the secondary market, which almost all lenders have to do. Because imagine if you had just a pool of $10,000 and you posted out there to your friends, everybody can borrow $1,000 if they'd like. I'm here to help everybody. Okay, when within no time your 10,000's gone, you're like, well, I helped those people, and then a lot of people are going to go, oh man, you already lent out all your 10,000. Yeah, sorry, I don't have any more for years. The one guy's supposed to pay me back in 3 years. I'll have that, man. So that's what would happen if you were just a bank and you lent out the money you have. So what happens is there's a secondary market where people agree to pay money for those loans. So let's say you got someone over here willing to pay $1,020 for your $1,000 loan to this guy who said he's going to pay it back in 6 payments. He just needs help right now, had to get tires for his car or whatever. Then you sell that loan to him. That frees up your $1,000. You're like, hey guys, I have another $1,000 to lend. So that's how most lenders work. They do have their own capital, but once they start approaching having 70, 80, 90% of that lent out, they have to start selling some of those loans in order to be able to make new loans. Otherwise, they just sit there and now they're just a payment collector, and the jobs go away that are inside that company. Kind of went off on a tangent there. So anyway, what I want to show is you have a condo, there's no hits if it's 60% or less, or 70 or 75. But look, as soon as you get into the 75 to 80, oh, there's a cost to do a condo at 80% loan to value. And actually that same cost carries over all the way. So you might go, well, geez, I was just told I could get a 5% loan on a house, but you're telling me now it's 5.25% on a condo. It's because your lender is factoring in this cost to deliver the loan. He might just be able to ask him, go, hey, what would be the cost to get to that rate? So I'm just trying to inform borrowers and also anybody else in the field who has never really seen these numbers before. As you can see, investment properties have very high costs. If you get up here in the 80 to 85%, you have to pay 4 points to get the rates of someone who's buying it as a house they're going to live in. Second homes have similar costs like this too. Not quite as bad. At the lower amounts, they're a little bit less, but then they start matching investment properties as you get higher. Second homes, you can borrow a higher LTV. On investment properties, they cap you at 85%. Then we have the hits for 2 units and 3 units and 4 units. So I just wanted to bring this to you. So in reality, everybody does have access to the quoted rate or the lowest rate. but you're going to have what's referred to as adjustments to price or cost to get to that rate. And these are cumulative. So if you have, a low credit score and you're looking at buying a second home or an investment property, you can see how quickly these can add up. You're talking about a 3-point hit for your credit score, and you're talking about a 2-point hit for the type of property. So you have 5% on a $400,000 loan. You're going to have to bring an additional $20,000 approximately to closing in order to get that rate, have that payment, and things of that sort. All right. So that was just my, mortgage minute that I wanted to share with you guys. Thanks so much for coming in. If you'd give the video a like and comments too. I do look at the comments and respond as quick as I can. I usually get in there once a day, sometimes twice a day. So if you do leave a comment, I'll a lot of times get to it the same day, sometimes the very next day. Okay, make it a great day out there.